In this lecture on inbound taxation of electronic commerce, we focus on the U.S. taxation of business income of foreign persons under the U.S. Code. The objectives of this lecture are as follows: to understand when a company from a foreign country is subject to U.S. tax on business income under the U.S. Code. And to accomplish this objective, we will study how to do the following. Identify when such a person is engaged in a U.S. trade or business and therefore subject to U.S. income tax on business income under the U.S. Code on income that is effectively connected with that U.S. trade or business. And identify when business income is effectively connected with the conduct of a U.S. trade or business. And obtain a brief understanding of when non-business income is subject to U.S. income tax under the U.S. Code. First, let us look at the relationship between the taxation under the U.S. Code versus taxation under U.S. tax treaties. The U.S. taxability of a foreign person is determined by the provisions of U.S. tax law as set out in the U.S. Code and regulations. However, if there is a U.S. tax treaty and the foreign person elects to apply that treaty, then the tax treaty provisions ordinarily supersede U.S. tax law set out in the code. Therefore, the ordinary analysis requires examining the U.S. code provisions and then examining applicable tax treaty provisions, if any, and electing to follow the treaty provisions if they are more beneficial, or ignoring the treaty and following the U.S. code if that is more beneficial. This lecture covers only the U.S. code part of the analysis. The rules for tax treaties are covered in a separate lecture. Here are the basic rules for taxation of a foreign person's business income under the U.S. Code. Under the U.S. Code, foreign persons are taxable on business income when that income is effectively connected with the conduct of a U.S. trade or business. This income is otherwise known as effectively connected income. There is effectively connected income if the foreign person is engaged in a U.S. trade or business and there is income that is effectively connected with that U.S. trade or business. Contrast this rule with the rule for non-business income, such as interest, dividends, rents, and royalties, which is taxable in the U.S. solely by reason of being U.S. source income. Here are the basic rules for taxation of effectively connected income. When a foreign person is taxable on income that is effectively connected with the conduct of a U.S. trade or business, the tax is calculated as if the foreign person was a U.S. taxpayer. That is, the taxpayer reports effectively connected gross income, reduced by related deductions, resulting in effectively connected taxable income. This effectively connected taxable income is taxed at normal rates applied to U.S. citizens, residents, and domestic corporations. Compare taxation of effectively connected income to that of non-business income, which is taxed at a flat rate of 30% and is not reduced by deductions. Taxation of non-business income is discussed later. Business income is taxed in the United States if it is effectively connected with a U.S. trade or business. So let's take a look at the requirements for a U.S. trade or business. There is no easy way to determine if a foreign person is engaged in a U.S. trade or business, and the IRS will not rule on this question ahead of time. Whether there is a U.S. trade or business is determined based on the facts, and most guidance we have on this subject comes from the courts. The best we can say is that for there to be a U.S. trade or business, the taxpayer must be involved in business activities in the United States. The activities must be engaged in with continuity and regularity. And the taxpayer's primary purpose for engaging in the activities must be for income or profit. It is worth noting that it is unlikely that an online company will have a U.S. trade or business despite regular sales to U.S. customers if neither the company nor its agents has physical presence in the United States. However, there is no guarantee that the lack of physical presence equates to lack of a U.S. trade or business. Foreign Webco is an online seller of electronics. All of its business activities, including the activities associated with the operation of its web server, take place in country X. Foreign Webco's web server is located in country X. All product sales to U.S. customers are shipped directly from country X to those customers. Because Foreign Webco does not engage in any business activities in the United States, it is unlikely that the company is engaged in a U.S. trade or business. Let us look at some of the cases involved in the existence of a U.S. trade or business. The first case is Grotzinger, which addresses the existence of a trade or business, which is the first leg of the U.S. trade or business analysis. To have a U.S. trade or business, there must be first a trade or business. Grotzinger involved a gambler and the question of whether the gambler was engaged in a trade or business. This case has great value as a complete examination of what a trade or business is. The case tells us that for an activity to constitute a trade or business, regardless of whether the activity is operated by a U.S. or foreign person, the taxpayer must first be involved in the activity with continuity and regularity, and the taxpayer's primary purpose for engaging in the activity must be for income or profit. The second leg of the U.S. trade or business analysis is to determine if the trade or business takes place in the United States. A foreign person may be engaged in a trade or business, but that business is not a U.S. trade or business unless it is carried on in the United States. A good case that illustrates this point is Scottish American Trust. In this case, the foreign taxpayer was apparently engaged in a trade or business, but not in the United States. Under the facts, the U.S. office of this foreign company was not engaged in the U.S. trade or business, and the real business of the company took place outside the U.S. The U.S. activities of the U.S. office were merely helpfully adjunct. One of the few activities where there is guidance in the code on the existence of a U.S. trade or business involves personal services. Under the code, the performance of personal services in the United States constitutes a U.S. trade or business. There's a limited exception to this rule where personal services performed by a non-resident alien for a foreign employer do not create a U.S. trade or business. However, this exemption is not useful since it requires that the individual is present in the United States for not more than 90 days, and more importantly, the total income from such services is $3,000 or less. Let's discuss the effect of agents in the United States on the U.S. trade or business analysis. A foreign company can be deemed to have a U.S. trade or business if it has agents in the United States. This is perhaps one of the trickiest analyses of the U.S. trade or business analysis. In general, a person is an agent that causes a foreign person to be engaged in a U.S. trade or business if The person acts on behalf of the foreign person as an agent, such as entering into contracts on behalf of the foreign person that bind that foreign person, where the activities of the agent are such that if the foreign person performed the activities in the United States, the foreign person would be engaged in a U.S. trade or business. Foreign Web Co. is an online seller of electronics. Most of its business activities take place in country X, and Foreign Web Co.'s web server is located in country X. All product sales to U.S. customers are shipped directly from country X to those customers. Foreign Web Co.'s only presence in the United States is an agent who sells enterprise hardware and software on behalf of Foreign Web Co. to U.S. business customers. He has authority to bind Foreign Web Co. This agent is not an employee of Foreign Web Co. and he is paid a commission, not a salary. Absent the presence of this agent, Foreign Web Co. would not be engaged in a U.S. trade or business because neither it nor its agents would be engaging in business activities in the United States. However, the mere presence of this agent acting on its behalf can cause Foreign Web Co. to be engaged in a U.S. trade or business. In the world of e-commerce, the question of agency creates many uncertainties for the U.S. trade or business analysis. All of these situations are discussed in the text. For instance, if a U.S. company hosts a foreign person's website in the United States, does that make the hosting company an agent? Do support services in the United States, such as call center services, make the support service provider an agent? And if either of these situations creates a U.S. agent, do the agent's activities constitute a U.S. trade or business for the foreign person? If a foreign person has property in the United States, is there a trade or business? Whether a foreign person is engaged in a U.S. trade or business as a result of property in the United States is an unanswered question. For example, does the presence of the person's web server in the United States cause a U.S. trade or business? Does the presence of the foreign person's inventory or goods in the United States create a U.S. trade or business? Once it is determined that a foreign company is engaged in the conduct of a U.S. trade or business, we must determine the income that is effectively connected with that trade or business. As a general rule, most U.S. source business income will be considered income that is effectively connected with the conduct of a U.S. trade or business if the foreign company is engaged in a U.S. trade or business. The source of business income is determined under U.S. rules and is discussed elsewhere in this course. Key to the understanding of effectively connected income is the force of attraction rule. As noted earlier, when a foreign person has a U.S. trade or business, all U.S. source business income is effectively connected. This is known as the force of attraction rule. This rule applies even if the business income in question has no relation to the U.S. trade or business. Here's an example. Foreign Web Co. is a country X corporation that is engaged in a trade or business in the United States through 10 retail stores located in states X, Y, and Z. Obviously, any profits from these stores is effectively connected income. In addition, Foreign Web Co. operates a website in country X from which it sells downloaded digital products. Assume that the source of these online sales is the customer location. Any sales of digital products would be U.S. source income, and under the force of attraction rule would be effectively connected income even if the sales have no relationship with Foreign Web Co.'s retailing business in the United States. Here are some examples of business income that would be effectively connected income. If a foreign person is engaged in a U.S. trade or business, then inventory sales to U.S. customers that result in U.S. source income would be effectively connected. For example, Foreign Webco is a Country X corporation and a web-based bookseller. Assume that Foreign Webco is engaged in the conduct of a U.S. trade or business. Its U.S. source business income is deemed to be effectively connected with that business and therefore is subject to tax in the United States. Foreign Webco is both a publisher and reseller of books. During the year, sales to the U.S. of its own books totaled $100,000, and sales to the U.S. of books of other publishers totals $300,000. Income from the $300,000 in sales of purchased inventory, purchased books, is sourced to the United States and is effectively connected. On the other hand, the $100,000 in sales of manufactured books is not U.S. source income because the gross income is allocated entirely to country X where production takes place. So this income is not effectively connected. There's a special rule for sourcing inventory sales. As an exception to the general rule for sourcing the sales of inventory, if sales of inventory are attributable to a fixed place of business in the United States and no foreign office of the taxpayer participates significantly in the sale, then sales to non-U.S. customers are considered effectively connected. Here's an example. Foreign Webco is a Country X corporation with offices in the U.S. and Country X. Its U.S. office operates a website that sells electrical generators. During the tax year, Foreign Webco sells several generators through its U.S. office's website for use in country Y. Under this special rule, such sales are U.S. source income and effectively connected. However, if the Country X offices materially participated in those sales, then the income may not be U.S. source and therefore not effectively connected. Services performed in the United States ordinarily create U.S. source income that is effectively connected. Sales of services are effectively connected and taxed in the United States only if the services are performed at least partly in the United States. This follows the general rule that the source of services income is the place where the services are performed. This rule applies to all services, including online services. On the other hand, if a foreign person is engaged in a U.S. trade or business and provides online services to U.S. customers, but the performance of the services takes place outside the United States, then the services are generally not U.S. source income and not effectively connected. Foreign Webco is a Country X corporation engaged in providing free online access to daytime dramas, that is soap operas, broadcast in the language of Country X. The website has a large following in the United States and earns substantial income from U.S.-based advertisers. The company has a U.S. sales agent. The activities of this agent are substantial, and the company is deemed to have a U.S. trade or business. All of the activities of running the website are carried on by company employees in Country X, and under the rules for services income, all such income is sourced to Country X. Therefore, there is no effectively connected income related to advertising income from U.S. customers. Let's look at the electronically delivered software that creates effectively connected income. The determination of whether software sales result in effectively connected income does not consider whether software is or is not electronically delivered. Electronically delivered sales are treated the same as physically delivered sales. This rule regarding the effective electronic delivery may apply to all digital property sales. However, there is no certain answer on this. As discussed earlier, effectively connected gross income is reduced by related deductions in determining effectively connected taxable income. The determination of deductions against effectively connected gross income is beyond the scope of this course. Generally, however, once effectively connected gross income is determined, deductions are allocated to that income under specific rules in the codes and regulations. Under these rules, most deductions against effectively connected gross income are determined economically based on some rationale to allocate a portion of the foreign taxpayer's total deductions to that taxpayer's U.S. trade or business. There are also special rules, not unique to e-commerce, associated with certain kinds of deductions, including interest expense, research costs, employee compensation, and others. Now let's turn to non-business income. U.S. source non-business income of a foreign company is generally taxed in the United States. This is so regardless of whether the foreign company is engaged in the conduct of a U.S. trade or business. Such non-business income is subject to a flat 30% tax, which is required to be withheld by the payer. No deductions are allowed against this income in determining the 30% tax. Certain U.S. source non-business income is exempt from tax under the U.S. Code. This includes certain capital gains and certain interest income. Certain types of income, such as interest, dividends, and royalties, which are ordinarily taxed as non-business income, are actually taxed as effectively connected income. Such income is taxed as effectively connected when it is directly related to the U.S. trade or business under certain tests.